The Bank for International Settlements, or BIS, is the World Club of Central Banks. One of BIS's main tasks is to coordinate bank regulations to ensure that financial institutions comply with the same legal framework all over the world. This creates a level playing field. The BIS has a special committee that creates, discusses, and coordinates banking rules, the Basel Committee on Banking Supervision (BCBS), or just the committee. Since the BIS has its headquarters in the Swiss city of Basel, these bank rules are called the Basel Accords. There are various versions of the Basel rules, and that is why we talk about Basel I, Basel II, and Basel III. The Basel II Accord, which was published in 2004, introduced capital charges to cover operational risk. Apart from operational risk, Basel II also calls for capital buffers to cover credit and market risk. The higher the exposure to operational risk, the more capital the bank should set aside to protect itself against this risk. Of the three risk categories, operational risk usually is the least important in terms of capital charges. Still, the Basel II Accord has put operational risk firmly on the agenda. The committee provides a helping hand by publishing papers with principles and advice. The BCBS aims these papers at both supervisors and banks. The goal is to promote best practices in sound risk management and to structure the supervision process. The topic of this video is the document Principles for the Sound Management of Operational Risk and the Role of Supervision. The text was published in June 2011 and the document is available on the BIS website www.bis.org. We will briefly discuss the main topics and will take the banker's perspective and will explain what is covered in plain English. Our goal is to make the sometimes hard-to-read text more accessible. What is meant by operational risk, is the first question to ask. Let us take a look at the definition in the Basel II Accord text. So, it is the risk or loss from being poorly organized and from making mistakes. These mistakes can be caused by employees, systems, or external events. A couple of examples are helpful. Say, your bank does not instruct its agents to check a loan applicant's ID card, causing problems later in case the client defaults. This is an example of a failed process. A human mistake in an interest rate calculation is another illustration. Interruption of services due to a computer failure is also an operational risk. Would the computer servers become unavailable due to a power failure at the electricity company, the risk would come from an external event. And paying compensation due to a harassment lawsuit would be an example of a legal risk. Now we have a good understanding what is meant by operational risk. Before we move on, a couple of comments. Many developing economies are also implementing the Basel Accords. We should not forget that the BIS is a club of mainly rich countries. Hence, BIS regulation aims at larger, commercial banks operating internationally. The committee gives some leeway here, though. It states that a bank should take account of the nature, size, complexity, and risk profile of its activities. This means that one should not go overboard and should always ask oneself whether a principle is relevant to your bank. This can save you much work. The Basel documents often refer to an operational risk management framework. This framework is the management and documentation structure consisting of a documented risk strategy, a risk appetite statement, various procedures, and policies. The Basel document consists of 11 principles. We will discuss each of these principles briefly and explain the essence in this video. Of course, watching this video cannot replace reading the original document, however, we will provide a good resume. Here we go. Principle 1. The Board of Directors should take the lead in risk management. They should signal the importance of risk management, allocate sufficient means, and provide training. The idea is that the board emphasizes risk management's central role. A clear ethics policy should leave no doubt as to the principles and moral integrity the bank aims for. The fact that the very first principle points to the board's responsibilities underlines the importance of operational risk management. Principle 2. The gist of this principle is that the operational risk framework should be part of the overall risk management. It is a bit of a warning. Often, commercial banks tend to focus on the credit risk and market risk. Although operational risk is beyond the traditional financial realm, still banks should take it seriously. So, banks need to really embed the operational risk management framework. Principle 3. The board must review and examine the risk management framework regularly. This is to ensure that the framework does not remain a paper tiger, but that all defenses are in place, in order, and stay that way. Principle 4. Taking risks is part of a bank's business model. However, the board should reflect beforehand on how much operational risk is acceptable and to what degree it can be tolerated. The risk tolerance is expressed in the level of capital buffering to protect the bank against operational risk, and in terms of availability levels of, for instance, computer networks. Does the bank require teller networks to be available 95% of the time or 99.8%? The latter level is better from a risk standpoint, but it comes with extra costs and investments. Settling for a 95% uptime level might be less service-oriented, but could save investment money. The committee wants banks to determine which risks are acceptable and to document this. Principle 5. The bank's senior management is responsible for translating the board's risk management in concrete policies and actions. Governance structure they create should be clear and transparent. Principle underlines the senior management's key role. Principle 6. Operational risk management plays a role in all the bank's activities, whether this is a credit product, a computer system, or an accounting process. The Bank for International Settlements wants financial institutions to identify and assess these operational risks. The thinking is that the bank should know how much risk it is facing. Apart from naming and listing these operational risks, the bank should try to estimate the size of these risks. The committee suggests using several tools for this identification and assessment process. Think of audits, scenario analysis, collecting data on failures and risk events, and so on. This is part of a continuous process and should give the bank an idea how big the operational risks are and where to look for them. Only then, the bank can implement risk mitigation actions and measure the effect. Principle 7. The bank should not only identify and assess the operational risk for existing products, systems, and procedures, but also do the same for new ones. Whenever one introduces, for instance, a new product, there is an increased operational risk. The committee wants banks to gauge this risk up front before launching the new product. Principle 8. The bank should organize reporting on operational risk at all relevant levels. The reporting includes the potential risks to which the bank is exposed as well as the actual losses. Principle 9. This principle demands the bank to have a professional control environment. A well-organized bank checks on errors and deviations in products and processes and takes corrective actions. The bank should not only respond to deviations that occurred, but also try to foresee these risks. Principle 10. The idea behind this principle is that the bank is prepared for a problem or disaster that disrupts the bank's business activities. The bank should plan for this type of adverse events. To give a simple example, you can plan to switch to a battery or generator in case of a power failure. The message here is to think ahead. Principle 11. The Basel Committee wants banks to be open and transparent about their operational risk management. A central idea of the Basel Accords is that shareholders, customers, and employees will favor financial institutions that have sound risk management policies. To make this market function properly, the stakeholders must be well informed, hence, the emphasis is on disclosure and sharing of information. The Basel document splits the 11 principles over 3 categories or groups. 1. Fundamental principles of operational risk management. 2. Governance. 3. Risk management environment. Now, let us briefly summarize the 11 principles and organize them according to these groups. Principle 1. The Board of Directors takes the lead in the risk management culture. Principle 2. The bank should develop an integrated operational risk management framework. Principle 3. The board should establish, approve, and review the framework. Principle 4. The board should decide on a risk appetite and risk tolerance level. Principle 5. Senior management should develop a good governance structure. Principle 6 – Senior management should identify and assess operational risks. Principle 7 – Senior management should create an approval process for new products and activities. Principle 8 – Senior management should report on operational risk and actual losses. Principle 9 – Banks should have a strong control environment. Principle 10 – Banks should have continuity plans for when things go wrong. Principle 11 – Banks should be transparent about their operational risks. We hope this was helpful and wish you all the best with implementing the Basel Principles for Operational Risk.